All right. Welcome back to Stonkcast, the market show for the average Joe. Whether you're a diamond-handed degenerate looking for the next 500% play or a more conservative swing trader or investor, we've got you covered. We tackle the latest market news, give our 2 cents, and maybe, just maybe, help you make some money along the way. I'm your host, as always, Brandon Shar. And folks, as promised, we have a special episode today interviewing Kevin, aka the Market Bishop, for those who follow him on Discord. And very, very excited for this special we're doing here. Kevin, I've said it before, but I'll say it again. Thanks so much for taking time out of your busy schedule to come on.
Yeah, of course, man. It's my pleasure.
Awesome. So just to give everyone a brief rundown of what we're going to be doing here today, I got a few questions lined up for Kevin. We'll kind of walk through that. If anything pops up naturally, we'll of course discuss that. And excited. So let's jump right into it. So Kevin, first of all, I just want to kind of kick it off with, I guess, an opening or a background, right? So if you could you just share a little bit about your beginnings in the market, maybe what drew you to the market, and then, eventually led you to, mainly prioritizing, options as your main instrument, I guess.
Yeah, of course. It's a long story, but I'll keep it very short because it's kind of funny. But I was born in America, but I'm Indian. My parents were very hardworking, and they always strive to do better. So their hardworking thing kind of rubbed off on me. And I'm 24 now, so I actually started trading 12 years ago. And when I was around age of 12, back then Instagram was popular, so I used to grow like Instagram accounts and stuff like that. Just I like generating revenue is something satisfying for me. And that's when I started learning about the markets as a whole. And back then, one thing that was very popular was penny stocks, right? YouTube, unfortunately, was just filled with just buy my course stuff, and the only resource I had was books. So what I did was I read a bunch of books, primarily like Wyckoff books, Richard Wyckoff books, and other option strategy kind of books. But I first started off with penny stocks, and I realized that penny stocks doesn't represent the whole market, but it also shows the increased amount of volatility that you can face, right? Because there's a lot of volatility in that. So I love trading penny stocks, and I did really well. And I started to read more about options, right? Because I didn't want to trade something that's just not sustainable, right? Yeah, of course, I could get into a great penny stock trade, but that's not going to, that doesn't leave me in a situation where I could leave runners, right? Which is probably something we'll talk about later on. But I realized I want to trade the bigger stocks, and I didn't have the capital back then, right? I only started with $300 when I first started. So I wanted to trade, Apple, I wanted to trade Microsoft, all those companies, right? So I started reading into options, and that's when I first started. And there's just something so satisfying about trading options, whether it's, 2DT, 0DT, weeklies, or even monthlies. When you see that percentage increase and everything, you just can't step away. So yeah, man, I mean, it's primarily I was just a huge reader, and thank God for that. And one of the things that led me to be very successful is, and I'm privileged to say this because we're in a time where we're filled with influencers. I didn't have an influence. I was completely by myself, and that made me realize where I was stupid and where I was doing stuff right. And I was able to look at, what I was observing in terms of the market and the charts in front of me, and what I was doing as well. So that's kind of like the short version of the whole story. But yeah.
Sure. And I've heard you talk about Wyckoff before. I've read a ton of trading books. I don't think I've actually read anything of his yet, so I'll have to definitely check that out. And yeah, I can definitely relate on the options front. It's funny, Kevin and I were just talking offline about some of the crazy Tesla option plays that have been
Oh yeah.
going on lately, and you can get 500-600% on some of these if you're playing it right. So yeah, options are definitely a great vehicle to leverage, especially to get access, like you were saying, Kevin, right, to some of those higher price companies. If you can't buy 10,000 shares of Tesla right out the gate or something like that. So that's great. Okay, awesome. So I want to jump into a little bit of strategy and just, daily process, right? So, can you walk us through a little bit of your daily trading routine, such as, watch lists, and how you are finding various things? I know just from watching some of your own material, you have a very, very extensive watch list. So, I guess my question is, how long does it take you to actually go through that? And are you doing that towards the end of the day for swing trades, or the night before for day trades setting up the following day? Or, yeah, what does that look like for you?
Yeah, absolutely. And this is a very interesting topic because I think it's something a lot of people should talk about. And you actually touched bases on with me on this and what we want to revolve around, which is, over time you have to adapt, right? So
Yep.
with me, that actually includes my watches as well. 6 years ago, I was just primarily trading the companies that everyone trades, right? And Microsoft, Apple, Facebook when it was Facebook and stuff like that. But as time went on, the watch list changed. That's fine. But, during a bull market, you don't need to be looking at 1,000 different things, right? You could just maybe look at five and, be fine with that. But during a bear market is where you want to expand your watch list and see everything. So basically, to answer your question, it varies on the environment I'm in. For example, before we started having that, that short-term bear market, whatever you want to consider it, that huge drop down.
Hmm.
My watch list, yes, there was a huge S&P 500 watch list, but I primarily only traded a few set of companies. You obviously know Tesla's one of them, Meta's the other, Nvidia, Apple, Microsoft, and Google. Um, but I would say it's changed over time. When I was in high school and when I was in college, I had to make sure I was only looking at a few because I didn't have too much time in the morning before my classes or during classes to look at everything. So before it was simpler. I would say now that we're just completely, pushing to the upside, regardless of how valid or unvalid we think this rally is, we just had to keep it simple, right? So at least these past days and these past weeks, I'm just narrowing down my watch list. So the whole S&P 500 watch list is a watch list, for example, I would look at if I turn on my computer and I'm seeing, the market's down. All right, okay, if the market's down, what sectors are down, right? So if tech, usually when market's down, that means tech sector's down. So, okay, what sectors are doing really well? Usually be either oil, consumer staples, communications, stuff like that. But if the market's usually green, then I have to tell myself, okay, let me just try to stay a little bit simple and focus on what I know. So I just look at, the stocks that I usually love trading, such as Tesla and Meta. I see where it is. Um, and I'm a huge guy where, again, you always see the word simple from me because maybe I'm stupid and that's how I process things, right? But I delete my levels every single week and I redraw them because my whole philosophy is if a level is so important and so important for me to have on my chart, then if I delete them and look at the chart again, I should be able to see it again. So
Right.
in short, what I'm trying to say is it varies based on the environment. And now, since we're in a bull environment, and yes, there is skepticism about how much downside we could possibly have in the future, I am still keeping it simple. And, I still learn from my mistakes now, 12 years later. And I still repeat some mistakes again where I make it too complicated during a bull market. So during the bull phase, just very simple and just looking at where, my favorite stocks are. Are they gapping down a little bit? My favorite is when they're, around break even to yesterday's close, because that means that you can catch a lot of volatility usually within that day. Does that answer your question, or was there other things you want to talk about related to that?
No, that was great. Thanks so much. And just to kind of expand on that, I know you had mentioned, I want to say it was a couple weeks ago, right? Basically a regime switch as you were noticing it, and you kind of switched some of your process, if I understood correctly, from primarily swing trading and hardly any day trades to, polar opposite, right? Where now it's more day trades, and not as many swing trades. So can you just kind of expand on why you've made that switch? Is that in part due to this kind of, rally? We're seeing this bounce off of those April lows and, being 2% off an all-time high, or is it something else?
Yeah, of course. No, it's a really good question. So As I said before, we all have to adapt. Swing trading is just my bread and butter. That is something I'll always love. That is what actually got me into option trading. Right now, it wasn't really day trading; it was option, swing trading, and I'm great. I'm good at both. Respectively, I think I am. Um, and I always prefer to swing trade, but swing trades are really great in a high, not high, but at least a moderate IV environment, meaning, you have overnight gap ups and gap downs and stuff like that. And yes, swing trading is good in a bull market, but you've probably seen this, or maybe your viewers haven't. The drop we had was actually not a really high spike on IV or on the VIX, which is pretty crazy. But the IV crush we had after the rally afterwards is the largest in stock market history. So when you see that, that kind of puts in your head that, okay, if the volatility is dying down so much, swing trades are not going to be something that you can reliably focus on. Um, you look at any good company or any stock, right? Especially the big cap, mega cap stocks. Yes, there are some valid bull setups, but they don't actually you'll see, for example, Google go up one day and then the next day, but there's no setup for it to actually go up. It's just usually news
Sure.
or just people buying and stuff like that. So I realized that I'm like, okay, let me just swing trade because the volatility is during the intraday and not really overnight. So that's where I switched primarily to day trading. And I guess, to make it simple for anybody, to try to figure out which kind of environment you're in. If you're in a swing trading or day trading environment, is just look at the daily charts of whether it's SPY or, any company you really like, see if it's following patterns. And if it's not and it's just going a straight line, that's your one signal. Or you could look at the VIX, which you probably talked about before, and if it's just declining on such a steep rate, maybe it's not worth trying to swing trade because you could probably try to catch some moves intraday.
That's great. Thanks for breaking that down and tying in the VIX with what style of trading you're going to be doing is an excellent insight from your process and something I hope people can kind of pick up on because it makes sense, right? It's not just guesswork. There's a logic, there's a reason behind that assessment why you're switching into more of a day trading regime versus swing trading. So that's great. Um, and as far as levels, and I know you're a big fan of volume profile. Can you just briefly explain some of the tools that you're using, right? When you do find that company that is setting up, how do you know it's setting up beyond just the fact that, broadly speaking, it's going up or down for calls or puts, but what are some of your favorite tools to use? As I understand, you're not really a big user of like moving averages, right?
Yeah, so um, the funny thing is, again, I don't want to bore you or anything like that, but when I first started, obviously, indicators is one of the first thing you always want to study about. And the thing is, nowadays, I don't use indicators as much. I'll use the moving averages like the 200 or the 50, here and there. But the interesting thing is, if you actually study what calculates and what moves moving averages, for example, EMAs, SMAs, VWAP, MACD, RSI, it actually gives you a little bit better understanding of how the market works by just looking at a chart. So indicators, all it does is it shows a little bit of hidden data, but just simplifies what you're seeing. So I realize all those indicators are considered lagging indicators, right? Because they don't present the live time data. Only things that do is volume and price. So
Right.
my thing was, hey, I want to always keep the live stuff, so I'm going to stick to volume and price. So to answer your question, this is actually a really good question because I could relate it to something this week. You and some people who follow my trades or observe my trades know that I love trading both Tesla and Meta. But there was a certain reason why this week I did not trade Meta as much and I traded Tesla more. And it's a simple basis of volume, right? Meta, if you look on the daily chart, like the volume has been dying off very, very, on a steep rate the past week and starting last week. And usually when you have dying volume, that doesn't mean you have extended or very large intraday moves or even overnight moves. So yeah, you could still day trade it and you might have to wait a few hours for your move to work, but it's not going to happen at a rate that's reasonable, right? Because, you know, yeah, day trades are great and you could hold them for hours, but you need to also be efficient in your time and capital, or you're just mentally going to exhaust yourself. So to answer your question, let's say I'm looking at both Tesla and Meta, right? They're both at places I like, but just like this week, if I'm seeing that Tesla has more volume on the previous days or even overnight or in the morning, that's going to catch my attention more. So if I'm seeing, a great example is Tesla, right? Tesla had a very bearish day, I think, last week or the beginning of this week, and it was a high volume daily candle the day before, and I missed out on getting on a put swing. But it's fine because the next day, Tesla actually was opening up at break even, so right, yeah, at yesterday's close. So I love the fact that there was so much volume on the previous daily candle, which made me focus on that more. So not only was it opening at break even, it had a previous bearish candle on the daily chart. So I'm thinking, okay, right, my sentiment for now is going to be bearish. And if I see it open up, and it was opening up right where a level was, if I see it reject this or not able to claim that level, usually on the 5 minute, right? That's what I look for day trades. That I'm gonna, enter into puts. The reality is, I'm not always gonna win on every trade. I win a majority of them, but if the risk to reward, or I can't think of a better term, but if the opportunity is there, and you just sometimes have to follow your plan, I just follow. And yeah, so it's basically looking at the previous day, looking at what I like looking at, so there's a certain set of stocks, and then if the volume is good enough, right? If I'm seeing increasing volume or I'm not seeing a decline in volume, I would much prefer to day trade those stocks. And especially if it's opening up, again, as I said before, opening around break even prior to yesterday's close, then I can make a better judgment on, okay, it's opening up below yesterday's close, or rejecting yesterday's close. So it's much easier to go according to that.
Got it. Got it. Thanks for breaking that down. And moving on into some risk and decision making processes, right? With such a wide watch list that you have, can you just speak a little bit to, I guess, the importance of risk management, or how you manage risk, intraday or even on, a higher time frame, right? But I know just from, my own experience, it's very tempting to get pulled in the direction of, let's say over trading, or
Oh yeah.
really hitting that window between like 11 and 2 where there's really not a lot going on. You shouldn't be involved, but you have the chart up and you see a couple green candles and you get tempted to jump in, right? I think we've all been there. So,
Yeah.
how do you set rules for yourself to avoid, dead zones, if you will, right, throughout the day where volume isn't really there, and really, how do you manage the risk, I guess? Yeah.
Yeah, no, absolutely, man. That's a very good question because I'll be honest with you, I'm a very straightforward guy. I mean, no matter who it is, that's always going to be an issue, right? The only people who really conquered are or people who are like 60 years old and have their own hedge funds, right? Because they're financially responsible and they're not even in charge of those trades. So
Sure.
whenever somebody has like control of money and you see those green candles, like whatever, during the dead zone times is perfect name for that. It is hard to step out, and you could even see that, like, on I call it Tesla Fridays and Meta Fridays, right? I don't need to be trained that, but I'm still like I'm addicted to this stuff, so I just can't get off of it, right?
Sure.
Yeah, but the reality is, it's just you gotta. There's different ways, everyone perceives things differently. Everyone has different behaviors. Sometimes it's might be simple as just is it gonna sound so stupid, but maybe brilliant at the same time. I've sometimes found that trading outside is actually very beneficial. Why? Because it's just like I'm not a huge video game guy, but it's just like video games, right? A lot of people are very tunnel vision when they're playing video games, right? Or whenever they're reaching towards a goal, they're very tunnel vision. Same thing happens with trading, right? That's why we get into these stupid trades and we overtrade. It's because we're just staring at the chart, and I can't like I do it all the time. Even though I'm not trading, I still stare at it. So, doing something as simple as, just sitting outside, you just sit back for a second and then you realize, oh, wait, I'm outside, right? So then it's a little bit of an atmospheric change. I sometimes literally have my dogs so they can freaking distract me from looking at the chart like all freaking 8 hours of the market. But
Smart.
yeah, but, obviously not everybody could do that based on living situation or whatever, weather. So it's it's really just focusing on the long run. I think regardless of how many times we tell ourselves, "Oh, we're not trying to get rich quick," it's just always naturally gonna just tick into us. And
Yeah.
when we see, for example, a lot of people like trading zero DTEs, we see just that one red candle, that one green candle that makes us think, oh, let me get into that. I know it's going to break down. And even if we're right or wrong, like we have to admit, even if we overtrade, just because it worked out for us, it doesn't mean we were doing the right thing, right? We had to classify that as, at least I would think we would classify that as stupid, right? Because just because we're getting rewarded for doing something stupid doesn't mean that we'll be rewarded the next time. So
Sure.
I think it's a big shift of being a little bit more harder on yourself. Just not being too lenient. I think a big problem is people are too lenient and they see that they do stupid things and they get rewarded for it, and then they think that's just the way to go. And it might be the way to. I'll be honest, it might be the way to go right now because the ball. I would say it's a pretty stupid market right now. Everything just goes up, right?
Yeah.
But when it comes to one last thing I'll say, when it comes to risk management, as you said, it really depends on what you're trading, right? Your risk management on weeklies or swings is going to be way different than zero DTs. Fridays when I don't trade zero DTs until Fridays usually, unless it's not Fridays, it's SPX. But SPX or zero DTs on Tesla or Meta, it's always going to be my smallest positions compared to any time of the other week. And an additional factor is, okay, what am I trading? A stock such as Tesla is already so volatile. I already have the volatility. I don't need to increase the volatility with my increased capital in the position. So, for example, if I have an account where I'm only okay with putting up $5,000 in a trade, or let's say even $500 in a trade, I'm not going to put $500 in Tesla because I could get almost the same result by putting $250 versus putting $500 in a stock like Kroger's or Walmart, right? Because Kroger's and Walmart move slower versus Tesla moves quicker. So it's just, you have to be dynamic enough and you just can't be lenient on yourself. And we end up being really lenient, which is unfortunate to see because I've been on Disco for 8 years, even though I've been trading for 12. And what we're having right now, even though it's historical in terms of the IV crush we've had and just the huge rally we have to the upside, unfortunately, a lot of people go down this drain where they are very successful now, and then when reality sets in, because reality always does set in, maybe not the same every single time, but it does set in, a lot of people struggle. And even if, let's say, I remember this, the last thing I'll say, because I don't want to stretch on too long and bore you, but I
No.
remember this, I wouldn't say I've taught, but a lot of people have asked me questions over the years. And one guy back in 2020, he made over $1.2 million in profits, and he was just trading, like crazy. But then there was a few market setbacks, and all that $1 million in profits he gained, he lost all of that and actually lost even more,
Gosh.
yeah, afterwards. So it's just really not being lenient with yourself, think of the long run, because that, I mean, we're all here to make sure we either have this as a side income or completely replace our job, right?
Right.
Even if it's a hobby. So it's money in the end. Yeah.
Yeah, it's interesting you bring that up, and thanks for elaborating on that. It's interesting because right now I'm doing a mini series on the Disciplined Trader written by Mark Douglas, as I'm sure you know, and he has some amazing quotes in that book, and one of them is about how the market, each trade that you put on has the potential of fulfilling your wildest financial dreams of independence, and simultaneously the market stands ready and willing to take away everything you own. Like there's no other environment like that, right? Like, isn't that such a true statement?
It's
Like, I've read
amazing
that.
too. Yeah.
It's so true though, and that's why it's so enticing, I think, to take those dead zone trades and oh, I've hit my limit for the day, but just this one more, I'll just do half size. It's fine. I've hit my intraday stop, whatever. It's just one more. There's always that temptation there to overtrade or be lenient or break a rule because of that reality, which is that any given trade could be that home run. You just never know. It's kind of a twisted fate, right? But yeah, again, thanks for kind of clarifying on that. And as far as I just want to get into really briefly here, Do you have like, I know you said with Tesla being a bit more volatile, you have a different, risk limit there, but generally speaking, right, just across the board
Yeah.
for your average company, average options play, what would you generally recommend for percentage of your account that you're putting into that? Not necessarily what you're risking, but your max exposure for that open position, I guess.
Yeah, of course. And obviously, I'm not, licensed financial advisor or
Yeah,
anything like that. So it's just
not
all my
financial
opinions.
advice.
Yeah. Sorry, bro. I got trauma. I gotta always say that stuff.
Yeah, thanks for
Um,
the reminder.
but okay, let's just talk hypotheticals. Let's say usually, look, I've been on Discord for a while. Usually the rate average account, even though there's people who have cheaper accounts around $1,000. Usually you find a mix of people from $5,000 to $10,000. Let's say somebody has $5,000. Let's just use the low watermark. Um, I've actually talked about this in a live session where we went over risk management, and I talked about how swing trades are different than day trades. In day trades, primarily I would see myself sizing heavier compared to swing trades because swing trades you would get larger moves, right? Versus day trades, yeah, you get big moves, but nothing compares to overnight moves, right? So you would take that same kind of perspective and apply it to day trading as well in certain types of stocks. Let's take for example, what's a slow moving stock? Coca-Cola. Oh, give me one. You were gonna say something?
I was gonna say your favorite, Kroger's.
Oh, heck yeah. Okay. All right. Let's go Kroger, man. Okay, let's say Kroger's. Kroger's is a great safe haven. It's probably my favorite one of my favorites. And it's really great intraday. Sometimes it does range, of course, because it's a lower beta stock. And if people don't know what lower beta means, you should definitely read up on that. Um, but it's lower beta compared to Tesla. So let's take that hypothetical, right? $5,000 account. Usually you'll see around, social media or YouTube is like, oh, don't risk more than 1% of your account or, 5% of your account. I have a little bit of a different approach. Not everybody has the luxury of a big account. So they can't look at, oh, just 1%, because 1% of 5,000, and even though I'm Indian here, you got to correct me on my math if it's wrong. Uh, 1% of 5,000 isn't that just $50, right?
I, of 5,000, I think you're right.
If I'm
Yeah,
wrong,
yeah,
then
you're
correct
right.
me. I'll
You're
be
right.
disappointed. All right, okay.
Yeah,
So-
keep your Indian card.
Hell yeah. All right, let's go. So, who can risk $50 on the Tesla contract? That's like only on zero DTs, and then you're
Yeah,
just so that doesn't work out. And even if it's 5%, all right, you times that by five, that's $250. Okay, you can afford one contract. Okay, I get that. That's a valid argument. But what if, especially with intraday, this is the ability you have compared to swing trades. Instead of thinking, oh, this is how much money I'm going to put into the position, maybe think, okay, this is how much I'm going to risk on the position. What I mean by that, let's say, again, $5,000 account. Let's say I am on a daily basis, I am only okay with losing 1%. As we said, that's $50. That doesn't mean I need to go in with a $50 position, right? If we're trading intraday, which means we have a lot of control over what we're doing. That means we could theoretically get a $500 or even a $1,000 position, but only set our stop losses to where we lose only $50, which is 1% of our account. So, taking that perspective that I have into this situation, let's say we're trading Kroger's and Tesla. Maybe on something such as Tesla, I want to only risk 1% because let's just say I've seen that if Tesla goes against me, I've seen that it continues going against me. So I don't want to risk it more. Versus something like Kroger's, I want to maybe sorry, I had Thai food, so I might burp here and there. But I might want to only risk I might want to risk 2%, right? Because I've seen that even though sometimes Kroger's works against me, it is actually gone and reversed back into the way I want it. So something that's less volatility, I would risk just a little bit more of my account because there's less probability for it to actually continue proving me wrong. Versus the higher volatility stocks, I would look to do a lower percentage because not only would it work against you and work against you really strongly sometimes, but your contracts will always lose a lot more value, right? Because the IV comes into play there, right?
sure.
Tesla obviously has more IV on their contracts versus the options on Kroger's. So That's basically it. I'll just give one more quick example. $10,000 account, 1% is $100. Let's just say I buy, $2,000 worth of Kroger calls or $2,000 worth of Tesla calls. On the Kroger calls, I might be okay with risking 3%. So that's $300, right? I could still go in with 1,000 or 2,000, but that doesn't mean I'm, risking all of that capital. I'm only risking as much as I want to lose.
Sure.
Same thing with Tesla. I might want to risk only 1% of my account. So I'll take a $2,000 account position, but I'll only risk $100 of that. So that just is the way I approach it, actually.
Okay.
Yeah.
That's great. Thanks for breaking that down. So it's really dependent on, if I'm understanding correctly, right? It's basically dependent upon what that beta is, how volatile those, contracts could be. It's not a black and white situation across the board, right? Because I agree, you can't, excuse me, you can't really treat Kroger's and Tesla, as you were saying, the same, because they're not the same at all. They're going to move very differently. Do you have, everyone has their own risk management approach, but I always
Mhm.
like to ask, do you have like a hard set stop intraday worst case scenario? Hey, if I lose this percentage of my portfolio, I'm done for the day, or even for the week, or what does that look like for you, I guess?
Yeah. Okay. So I'll answer for what I do, and then
Sure.
I can answer what typically people I've seen done. Um, And if I ever just like don't answer your question, let me know because sometimes I explain too much and then I completely don't answer everything. But
No, this is great.
yeah,
Thanks.
so when it comes to me, when I let's say 4 years ago or 5 years ago, I was very consistent after my first year. I made a lot of mistakes my first year, of course, but then after that, I learned very quickly from them. Thank God for that. Or I guess I had that privilege. But as after my first year, I did have those kind of hard set rules where you're putting less trust in yourself, but you're putting more trust in your ability to not trust yourself. So, for example, if I ever had, when it came to day trading, I think there's more rules that you apply to day trading versus swing trading, right? Day trading, if I had two losses in a row, I'm gonna just stop right there, right? And then even diving, putting that under a microscope, usually my losses, I never wanted to be past like 25, maximum 40%, right? Because then I'm just sitting there and I'm thinking, okay, what am I doing here? Am I just sitting here with my, hands tucked underneath my legs and just hoping that something works, right? That's just not logical. So I usually end up, finding myself, I don't like calling myself an idiot, but I will call myself an idiot. So if I find myself being an idiot, I'll be like, okay, I need to step away. When it came to, that's a good question. I never thought about like not trading for the week, but I guess I have implemented something like that in the past. Not every single day or every single week is going to be great for trading. Not this week, but the prior week before, a lot of people lost money because it just was not a good environment to trade in. Years ago, I did used to, imply rules where if it just wasn't great, if the VIX wasn't looking great, I'm going to step away. Realistically now, that's all kind of changed over time because as the years have gone, I've been able to trust myself more. So I don't usually set my, hard set rules. Now the two straight losses in a row, yeah, of course that's gonna make me sit back and think, okay, should I trade it anymore? But if I see something and I'm not hitting a huge loss on my portfolio, then I'm gonna still take it, right? So then tying back to what you said about the portfolio and how much I lose on it, I never can afford myself, I never allow myself to lose more than 2% of my account. But of course, my account size is different than others, right? So that
Sure.
varies. I think when it was much smaller compared to now, it used to be 3%, 3 or 4%, because obviously smaller accounts have such a huge, range in terms of not market account gain and account loss. But yeah, usually for me, at least where I am now, realistically now, if I see 1%, I'm already thinking like, okay, let me just step away. 2% is like, okay, I'm like doing completely something that is not me. Usually, typically, people would, do, 20% stop losses, 30% stop losses. But the thing I have to counter against that is, that's only if you're trading one asset. People are just trading QQQ. That's fine. Everyone can do whatever they want to do. But historically, from what I've seen, you can't just be fixated on one thing. You have to know how to adapt, and that's the hugest thing. the greatest investors, I don't really have an idol, but if you look at them, they always adapt, right? And that's something everybody has to pick up on. Doesn't matter if we're in a zero DTE environment, and we kind of are these days. Um, you have to be prepared for when it's not. So your approaches to stop loss and risk management has to be different now versus than what it could be in the future. So mine is always changing. So right now, as I said, it's 1%, for me, 1 to 1.5%. Max is 2%. Yeah, if I see two losses in a row, I'm stepping away. I try to step away, but three losses is just my max. Like that's it. Like this week, it was very rare. This is the first time I had three losses in a row in like, it was something crazy, like 4 or 5 years. It was on two on AMD and one on Meta. And I told myself, okay, yeah, I gotta step away. So, yeah,
Yeah, sometimes thanks for breaking that down. That was excellent. Sometimes the best trade is no trade, right? I
yeah,
feel like the hardest thing, something I definitely struggle with, and I know a lot of new traders struggle with, is the ability to walk away because the market is it's so different, right? Like if you think
yeah,
about society, Mark Douglas touches on this in the Disciplined Trader too. The way that you go to work every morning, for example, doesn't change, right? It's the same
of
every
course.
morning, right? And it's like we're in such a static environment with rules, and if you do this, then this will happen. The market doesn't operate that way, and there's nobody over your shoulder telling you, "Hey, you're done for the day," right? You have to tell yourself that. So there's definitely a level of self discipline, right? That is needed to succeed. If you don't have discipline, you're not going to succeed. So in basically in you explaining all that, you're really emphasizing the importance of risk management, right? You're not necessarily thinking about how much you're going to make. You're focused on how much could I potentially lose on this, right? And I feel like all the best traders, right? If they're in a room, where's the exit? And the same thing
Yeah,
in a trade, right? It's
yeah,
like you
that's
need to
yeah.
know that. So yeah, that's great. Okay, awesome. And talking about stop losses and all this negativity, I want to flip it around to the other side of things because you are an excellent trimmer, and I got to know how you get some of these insane fills on on some of your contracts. So, could you just briefly explain your process in trimming, leaving runners? Because again, you get some incredible fills off spikes right off the open. Is that just something you've learned over time that generally speaking, you're going to get that volatility when the bell goes ding, and if it goes up, I need to de-risk here, or what does that look like for you?
Yeah, of course, it's a very good question. Obviously I post on Discord, right? Unfortunately, no matter how much I improve my bot that relays my trade ideas or my personal trades, it's just not there's always going to be a latency, and
Sure.
that's one factor to it. But I've used various trading platforms, but none of them, and again, I'm not sponsored obviously by them, but none of them have lived up to the fill time that Thinkorswim provides me. Um, I've talked about this before. Like you could set it up in such a way where, have you seen a ladder before on like it's where you
On
basically,
Thinkorswim,
yeah, you've seen it.
I think so. I feel like there's half because I use Thinkorswim. I friggin' love it. I feel
Yeah,
like half of the tools on there I don't even realize. Like that's how incredible of the software
yeah,
it is.
yeah. But, yeah. So basically, to tie back to how I get those fills, there's a few different factors on Thinkorswim. There's a charts tab on the desktop platform. I do all my trading on there. When it comes to options, 90% of it is all strictly on the active trader chart feature on Thinkorswim. So I'd actually
Yeah.
bring up the option that I'm looking at on the active trader, and I'll be able to trade it. And the great thing is, I could set my limit order anywhere on that ladder, which basically shows like if the bid of the contract is 95 cents and the ask is 105, it will show like all the values like 96, 97, 98, $1 and stuff like that. That's one of the hugest things that comes to when filling where I want to fill. I've also realized like depending on the stock, unfortunately, right? That's what makes this answer complicated. Depending on the stock, you have to realize where you want to fill. For example, a lot of people trade zero DTE, so I used to trade a lot too. But I'll talk about that. Let's talk about QQQ and SPY. The bid and ask is so tight that you could
Super
just
tight.
keep, yeah, you could just keep on trying to fill on the ask side and you won't get a bad fill, right? You could
Right.
even sometimes do a market fill, especially on Thinkorswim, and you won't really find much issues with it. But, for example, Tesla, especially Meta, which have wider bid and ask, you can't market order it because sometimes it might work, but majority of times it won't. You're gonna get screwed. So I would always try, I'm very quick with my fills. I always try filling at the mid. And if I'm not filled, I kid you not, if I'm not filled in like literally a fraction of a second, I will move that order up right to where the ask is. So same thing. Let's say usually in Meta, right, the bid and ask would be like 230 and 250. If I cannot fill it, you just have to like visualize like what's the midpoint. That's going to be 240, right? So if let's say I put 100 contracts and I tried to fill it in at 240, if it's not filling in just a second, I move it right up to 250. It's okay. Like I'll sacrifice it just to be able to get into the trade because the bid and ask is already so wide that if the move is on my side, I will still profit very immensely versus something like 0DTs. I don't have to be that meticulous about it. So that's how I get my fills. That it's largely based on that. And of course, let's say Tesla's shaping up, for example, a call setup. I don't wait till that moment to look at the calls and contracts I want. I already know which contract I want based on price, the delta, and so on and so forth. But the reality is, when it comes to the whole runners part you're talking about, not everyone will be able to share the success that I've had. And what I mean by that is recently. Back in the past, I wasn't able to hold it as long as I hold it now. And if I take 100 contracts of position at $2.50, I'm not holding all 100 contracts to, like, for example, 100%. Maybe even to 100%, I'm only holding out of the 100, maybe just five, right? There's been so many times where I just do that. A lot of times, majority of my position is trimmed out by before 40%. So I like taking majority of my profit by 30% because we should always, keep track of our trades, but just prior results. You always heard this saying, prior results doesn't always advocate for future results, right? So just because, for example, my average percentage gain used to be like, I kid you not, for 2024 all the way back till 2016, my average percentage return for option trades over across the whole years for each year was always above 150. So each trade,
Wow.
even including the losses, always reached that. But does that mean I keep my runners all the way till that point? No, I only keep a very small amount. But this year, I'll be honest, it's way lower, right? Because it's a different market. I was prepared, but then, I was very prepared during the bear market, but I'll be very upfront. I was not prepared for that rally to the amount that it went. I predicted the bounce, but just not the volatility and just the extent it went. And that's what hurt me at first. So what I'm trying to say is, even though my average win percentage was average gain was, very high before, I've had to adjust how I hold my runners now. So for example, let's just take an easier example. Let's say I buy 10 contracts, back, a few years ago or even last year, I would be maybe holding out of 10 contracts, maybe I'll be holding, four to 100%. But nowadays, now that I'm seeing that it's a different environment and I need to be a little bit more careful, I'm not holding four to that point. I'm only holding two and one, or two or one, right? But so when it comes to holding runners, I think the reason why it's very hard for people is not because of capital issues, and it might be, right. It's not really because of capital issues, but it's just all mental, right? I mean, it's so weird, and everybody has gone through this. We are so easily capable of holding our losers for so long, but the second like few dollars, bro, that comes up, oh, go ahead, say what you're gonna say.
No, sorry. I was just, you read my mind because that's exactly what I was gonna say. It's so true, Kevin. Like
Uh,
we have it backwards, right? Usually in losing trades, we're hopeful, right? And then
yeah.
we're fearful in winning trades, and really needs to be the opposite. That happened to me yesterday in the VIX. I was so
Oh,
concerned about it, getting depleted of premium value there, right? I ended up selling, and then when I was journaling at the end of the day and looking at my take profit, it easily hit that. I could have easily held it.
yeah.
it was still a nice win, but it goes back to your point, right? Of just being fearful, in a winning trade. It's like that's when you should be hoping,
Yeah.
So
No, absolutely. I mean, it, you could tie it to any sports, right? Like, for example, you could see what's important these days if you primarily watch football and basketball. Like, nobody cares if, you know, my favorite, everyone's going to judge me for this. My favorite quarterback is freaking Russell Wilson. And my favorite NBA player is LeBron James, just because I watched him grow up. But, you know, nobody cares about the way Russell Wilson plays these days because he doesn't have like 60 attempts of passing and then 48 completions, or just like he doesn't pass too much, right? And it's the same thing that
yeah,
happens with trading. If you're so worried about winning constantly too much and just having a quote unquote green trade, how can you how can you really expect yourself to grow and accumulate the capital growth that you want, right? You have to be fine with, like, for example, that example you talked about, let's say, is not always just aiming for percentages as well. I don't aim for percentages when it comes to holding my runners. When it comes to trimming, yes, I will trim at 30%. That's just the right thing to do in my mind. But when it comes to, let's say, if I'm buying Tesla, and what was the price of Tesla? I think Tesla at close was somewhere near 325, right? So let's
yeah.
say I bought calls right now, and my initial plan is okay. You know, I'm gonna get out of Tesla if it gets exits below 324, but I want to see it test 330. Of course, it's not invalid to trim beforehand, but why not be wrong because you had a plan and you were wrong on the plan, and then you can adapt to it instead of just thinking. And this is the funny thing. I've realized that we always take profit too early, especially novice traders, and I see that a lot. We take profit too early because we're trying to correct the mistakes before. So we're like, oh, I got to take profit now because, the smart part of me thinking, I've lost too much money. And it's because I was too greedy before. So let me just, click that
Yep.
button. Let me take $50 profit.
You won't go broke taking profit, right?
Yeah, look, I can't argue that statement, but it's also very situational. And that's why, I never have, you see my YouTube videos. They're long for a reason. They're not just the 7 minute or 15-minute videos. And I'm not even trying to advertise my YouTube video. I'm just talking about, like,
No, go for it.
it's you need to talk about all the perspectives and situations because everything is different for whatever stock you're trading, whatever
Yeah.
method, whether it's scalp or day trades. And it's just, you can't expect, sometimes you do have to hold because those trades could actually go to the point you want to hold. If you see valid forms of invalidation, then yeah, of course, I'm not going to, argue about, you never go broke trimming. And if you have, let's say, it's not wrong to have a risk management strategy, which was very popular back in the day, where the stop loss was at 15% and your take profit was at 30%. That's fine. That's fine. But when you're in a market like this, you can't do that because now you can't do that all the time because sometimes that's really going to hurt your accumulation, and accumulation is everything, man. I mean, why are dividend stocks some of the greatest long-term assets of all time when it comes to stock market compared to even growth stocks? Is because they just keep on accumulating. If you keep on taking the dividends and reinvesting it back in, it just grows to such an exponential amount. And yeah, growth stocks do great. They give you such an amazing amount of growth, but you have to sell that to realize those capitals versus dividends, it keeps on accumulating. And yeah, it grows with you as well, but you don't have to sell that to retain the reward. So it's something similar here with the runner's part. You just have to be okay with being wrong. And, I say this because a lot of traders are usually male, right? And it's a predominantly male dominated, I would say, job, right? Because I view this as a job, and we have to realize, and excuse my vulgar words here, we have to realize we have balls, and back in history, every single emperor, every single war general was not right all the time. They unfortunately lost men along the way, and they lost all these battles, but in the long run, the risk that they took ended up playing really well. No one was just exponentially successful. Even the investors or even war generals many years ago were not successful by just taking minimal risk. And I mean, we're trading risk. That's all it is. And why is a lion more beautiful than a chicken, right? A chicken doesn't harm us right? But a lion can, but it's just so beautiful in our eyes because if you have a bond with a lion, it's just like what I don't know where I'm going with this, but you get where I'm going with this,
I
right?
like
So
it.
yeah, yeah,
No, that's great. Thanks for sharing that. And one thing I thought of too also is I feel like a lot of people when they're prematurely taking profits, it's in part because they don't trust their system, right?
yeah.
If you truly believe you have an edge and your trading plan is has a winning probability, there's no reason for you to take off unless there's some, nuanced news that comes out, right, changes the game plan. But generally speaking, I think it's in part due to just a lack of not trusting your process, right? Is that fair?
Oh, absolutely, man. Absolutely. I mean,
Yeah.
we always self-doubt. That's the unfortunate part, right? I have to say, and I don't mean to go on, but I have to say one thing that I'm privileged for is, as you can tell by my voice, I am able to be monotone, and I've been luckily really privileged to be able to do that while trading. So yes, emotions do creep in from here and there, but if you're not able to do that, it's very hard to do this, and self-doubt is an emotion. So um, you know, everyone thinks self-doubt is very detrimental, but self-doubt also leads to the most, I would say, I would say the most hurtful emotion is actually not greed or stupidity when it comes to trading. I think it's hesitant, being hesitant, right? And whether it's entering your trade or holding your position, if you're just hesitant, that just causes so many issues down the road. It's just, it's
That's interesting.
unavoidable. Yeah, yeah, that's my thoughts on that.
That's good. That's good. Well, hey, I just got a couple more questions here, and then we can wrap it up, or if you got anything else you want to talk about. But I think that going into like edge growth advice, right? We have a lot of newer traders that tune into the show, so I just want to kind of go over how your edge has evolved over time. And I guess you've kind of talked about this in the beginning, but how do you continuously improve as a trader, right? You've been in it for over a decade now. I'm sure there's a temptation to get complacent, but how do you continue to ensure that you're evolving?
Really good question. I think, you can ask me that and I could go on for hours, honestly. And, even if I touched base upon it before, there's still many intricacies, right? Because nothing's very simple. Let me give you a very honest fact, right? Why did my average percentage gain drop from last year to this year, right? Even though my win rate's still the same. It's because I was very comfortable trading the way I used to trade, and I didn't adapt it very quickly for when the market started rallying, right? So the way I look back is I look at what, sorry, just reaffirm what your question was, if you don't mind.
Yeah, yeah. So, basically, just how do you how do you make sure you're evolving as a trader, or I guess if you have a process that you find consistently working, maybe there isn't a need for that. I guess in my head, I'm just thinking that there's no one set strategy, right, that is going to
Correct.
work all the time through all the different regimes, right? And so because of that, there's a necessity to evolve, right? So I guess my question to you is more so, how has that looked over the years? How do you ensure? How do you do a check in and say, hey, you know what? It's time that I need to explore some different strategies. What does that process look like? I guess, if
Yeah,
anything.
of course. That's a good question. So, the perspective I've always had is, as I've always said, every human perceives things very differently. The way I trade, in terms of looking at price and volume, maybe might not be the best thing for somebody else. Like maybe some people just genuinely cannot trade without something on their chart other else than price and volume. That's completely fine. Um, but I've always thought once you found something that's worked during a certain amount of time and it's actually been helping you out, and the only thing that's counterproductive is just your own risk management and stuff like that, then you don't need to change it too much, but you need to make adjustments to how you take the trades and, your sizing and everything. I think it's less of an approach of changing strategy and more of an approach of changing sizing and risk management. But that doesn't mean I don't fine tune what I'm looking at every single day. A lot of people and it sucks. But a lot of people, they trade. I'm in Eastern time, so they trade till 4 p.m. Eastern, and then just walk away. That's it. Maybe they'll look at the charts, at night before they sleep to see where the futures are, just to look at charts. But you know, I I'm very addicted to this, and it takes a lot of hours in my life, to be honest with you. And, I might finish trading at 4 p.m. Eastern. Yes, I might go take an hour break, but then I come back, and if I have any losses in the day, I try to see, okay, what went wrong. And if it's something just based off of me missing something, I'm not making too much of an adjustment. But if it's something I saw and I didn't recognize it as something important to see, that's when I need to be like, okay, I need to make sure I adjust to see this. Especially, I'll keep it in the back of my head. And then again, let's say a few days later or after a set of days, I still keep on seeing that same uh, mistake repeating over and over again. Then that's something like, okay, I need to uh, change this. Here's a really great example. During the drop we've had, I used to love trading the put setups, whether it was on Tesla, Meta, and everything like that, right? And all the bear flags worked out for days. Of course, that's a bear market, right?
Yeah.
But what I did was, realistically, the way a bear market works is we have an initial drop, we have a rally, and then we have another drop. We never had that another drop. So then what we just had was just an event-based bear market, because it was a bear market, a short-lived one, but it was definitely one. And then I didn't realize that. So I still kept on taking put setups. Even though the volume was there, even though the price kept on showing it, I still kept on taking it. And the funny thing is, even though I was not invalid in what I was taking, it was textbook, bear setups, it just was not what the market wanted, right? The market kept on going up. Um, if you actually don't mind, I could show my screen really quickly. Can I show
Please.
it?
Yeah, yeah, go for it.
Let me see if I can. I'm Indian, so I better be able to figure this tech out. I'm just kidding.
Yeah. Hopefully there's should be a share button on your side.
Yeah. All right.
Beautiful.
You can see this.
Yep. Yep. Perfect.
Um, let's go here. So I'll talk about. I don't usually have emotions when I trade, as you could tell by my freaking dumb monotone voice. But I do have to admit, I think it was on Thursday. I did freaking. I wouldn't say get pissed off, but I was very pissed off, and it was with AMD. And this is where I took the. This was the start of the 3 losses in a row. 2 of them were on AMD. Okay, this day was AMD was setting up for a bear flag, right? You could see here on the 30-minute prior to when I took this bear flag, we had a huge rejection, right? Over here on the top, and we were starting to creep up a little bit, but you could see the volume wasn't anything, really presentable or making me think, okay, it's gonna reverse into the upside. So my sentiment was short, and especially the thing I didn't realize was AMD was having a keynote thing that day. But the funny thing is, when I first entered into the first set of puts, the keynote wasn't even happening. But somehow, this ended up happening. I entered right after this 5-minute candle closed, right? So you could see that I've always talked about price and volume. So I'll just very quickly go over what I saw here. I saw rising price. I like seeing huge wicks, which represents the strength of whether it's a buyers or sellers. Obviously, this represented that the sellers were way weaker, way stronger than the buyers, and the buyers weren't able to maintain that price. And you've had a trendline rejection, right? So I had this, and then additional to this reversal candle printing, if you see here on the bottom, you could see that the corresponding, and I'll point
The
it out.
volume, right?
Yeah, it spiked up. So you would
Yeah.
expect a follow through, but that never happened. In fact, what I got here was just this, I don't even know what candle that is, but it just ended up rallying. This was a 25% loss. I exited right here. I got back in over here, and not even, I got back in this candle over here, and you could see what happened. It ended up going up, and I, again, got stopped out. I stopped myself out. I don't use hard stops, actually, to be honest with you. But you could see, apparently, the whole world realized that Lisa Su was the CEO of AMD, and when she walked out on the stage, that's when AMD freaking tanked. And the contracts I was in that I no longer was in ended up going over 300% by yesterday. So
That's so annoying.
yeah, dude. So what I'm trying to show here, related to what you're talking about or asking, is, this was really a moment for me where I realized, okay, if I'm not trading zero DTEs, right? If I don't
Hmm.
have the volatility, right? Because zero DTEs, I could have taken this bear setup and maybe I could have made just a little bit of profit, so it wouldn't have
Sure.
been a huge hit. But I should just, until there's signs for the market actually coming down, I should just, primarily go back to focusing on calls. And that's the lesson I learned on Thursday when I was trading AMD. I'm like, okay, you know what? It's just, you know, there's no reason for me to just fight this, and I'm not trying to because I'm one of the biggest bull traders I know. But since I was so stuck by the bias that we're gonna come down after that, that rally, I ended up going for this put setup, and even though it was valid, it still didn't fall through. So that was kind of something like where I refine what I usually do.
That's great. And if you could lead this up for a second,
Yeah.
I would love to get just kind of your take. I know we were talking about Tesla. Obviously, it's been in the news with President Trump and Elon, some of the drama that's been going on there, and then we got some somewhat bullish news that came out on Friday. But with it being more, one of the high beta stocks, and now in light of this Israel Iran conflict, like I would just love to get your brief overview of where you see this thing going, I guess. Do you believe there's going to be more downside? It seems like we're actually in a bull market now, right? Being
Yeah.
up off 20% from the April lows, technically speaking. So I would imagine it's safe to say that, hey, look, I don't think Tesla's going to see 200 anytime soon, but what do you think?
That's a really good question. Usually you would say that wars are bullish for U.S. economy and stock market, but initial attacks, especially something that leads to potential nuclear warfare, not saying we're going to reach that extent, but with the danger of that, you don't expect just, and I'll show you, you probably saw it. I was looking at MES, because
Mm-hmm.
that's what I primarily trade. You know, if we go to the 30-minute and we go to when Israel striked Iran, yeah, we had this huge drop and we dropped all the way here, but then a complete like reclaim of almost
Wild.
everything. That's just like okay, it's just that was weird to me. So what that shows me is we can have all our conspiracy theories and everything, and I got quite a few of my own, but what this tells me is unfortunately we just cannot go thinking too much into this because that's what's actually been the reason for a lot of people getting burned. They're thinking too much, right?
Yeah.
All the people who are, and I don't mean this against anybody, because if you're doing well, props to you, but a lot of people who are consistently profitable in the past month are people I would classify as very stupid traders. Meaning they don't do anything complicated. They don't think about, foreign affairs or anything like that. They don't think about the fundamentals or anything. They just trade on the 1 minute chart and that's it. And they just go according to that. And they've been doing fine, zero DT traders and all that. Um, so this just comes to show me after a bounce like that, after a nuclear country striked a country that was building a nuclear program, is kind of concerning for me. And what was concerning is we rallied, but then, obviously after the noon of yesterday, we completely gave up everything that was, there the prior day and more. So, to be honest with you, man, historically, you would assume we would have more downside, and everyone's like, everyone's concerned about, I think SPY printed like a really ugly reversal candle right here, right? And the funny thing is, I don't know when I drew this drawing, but I really hope it doesn't come to fruition because then this is something we'll be looking at. And I don't want to draw out my fibs because that will scare out people, but that's a realistic scenario.
Yeah.
Like, if
I
you're
mean,
looking,
it's still
yeah,
possible. It's still possible. That's the thing. Like you can't rule it out.
that's the thing, bro. Like, I'm I'm a very reasonable guy when it comes to trading. Like I want the market to be bullish, but you have to realize to be a perma bull or whatever you want to classify, if you want to be a bullish person, you need to know when setbacks need to happen.
Yeah.
A
And
setback should, sorry, go ahead.
sorry, just for quick context for those who are going to be hearing this on iTunes, Spotify, Kevin's showing a chart of SPY just tanking hard.
Oh,
So like a
my
complete
bad.
rally just being eradicated eventually is a potential situation. So Go ahead, Kevin.
Yeah, yeah, of course. Sorry, I forgot you were posting this on iTunes.
Sure.
But yeah, basically, on the chart, all it is, technical traders will look at this and be like, oh, we're at a supply zone, so we're just gonna probably reject here, and you can't argue with that. But then, in bull markets, you also can't try to short too much because then you're gonna get burned. So the main story is, do we just wait for the, reversal to happen to the downside if it happens, and then we just react based on that? And, historically, the people who have been consistent are people who react instead of trying to be preemptive in their, their actions. I think, look, the 12-year trading trader in me says we're going to have a pullback. The extent of the pullback, I'll be honest, I can't predict. If I mean, now that we're back in a bull market, as you said, the definition is whenever you go 20% up or 20% down. I would assume we don't go, for example, SPY below like 520 or 540, right? Because then you create a higher low, and then you could proceed upwards. But at the nature that we dropped, to the extent and the nature that we rallied, is just inhumane. And the only other time you could relate this to is back in, when was this? 2020, right? Yeah, 2020, where we just had a massive drop, and that was a much more longer lasting drop. That's the funny thing. And then we had a very huge short squeeze to the upside. So
Right.
yeah,
One thing I think is also interesting, Kevin,
yeah,
that I heard yesterday is that if you look at the VIX reaction to that news between Israel and Iran, and you compare that to the VIX on, reciprocal tariffs, I mean, they're not even close.
oh
It's
no,
like
no,
night and day, right? Like, wouldn't you expect a bigger VIX reaction, based off that? I mean, like you were saying, we had such a weird recovery that happened yesterday morning on Friday morning. Because I was watching the futures market on Thursday evening, like 8:39 when the news came out,
yeah.
and all of a sudden, right out the gate, you got the Qs down 1.5%, right? You got SPY down, you got the VIX popping 14%, and it's looking like tomorrow's going to be a 2.5, maybe even 3% sell-off day, and then you just have this weird recovery.
Yeah, no, absolutely. So, I mean, I don't know if I studied this before, but the VIX pop we had, when the tariff thing came out, for the extent that the SPY, S&P 500 or SPY dropped, it was the smallest VIX increase in stock market history. So there's few things you can refer to what that means, right? So either that means we are not prepared for what's about to come, meaning it could get a lot worse.
Sure.
And if volatility was that low for that kind of a drop, it's going to get a lot worse. Or you could say that, that drop was, yes, it was very volatile, but it wasn't too drastic that we had to be too concerned. Unfortunately, that's what makes it so hard to kind of figure out which way we go here, right? So I do have to agree with you though, when the tariffs came out, the market was going crazy. But now that we're on the verge of a potential, God forbid, but World War III, you see obviously that North Korea is backing up Iran now, right? I mean, we already know that Russia
Oh, I
is,
didn't see that.
yeah, that happened. North Korea apparently, I don't know to what extent, but they are going to be,
I guess that makes sense.
yeah, and there, of course, North Korea has nuclear weapons, and then, of
Sure.
course, Russia has nuclear weapons, and Russia is always an ally with Iran. And then, of course, what's Israel allies? You got Jordan, U.S., Egypt, Saudi Arabia, all these countries, for example, when Iran retaliated, helped defend against Iran's strikes against Israel, right? So
Right.
now you got a larger conflict, and for the magnitude that was, because it's not like you didn't predict, for example, us to predict Israel, you protect Israel, right? That was just, unfortunately, that's how it is, right? I don't know why we're doing it, but that's a whole nother story. But when we see that to such a dangerous conflict, then why is the VIX only going up that much, right? I remember I actually got VIX calls. I don't know if you saw this. I got VIX calls right before market close on when the Israel strike happened against Iran, and people were messaging me like crazy overnight. They're like, "Oh, your VIX calls are up like 80%," and
That's
I
the
was going,
ones I got into.
"Yeah, dude,"
Yeah, yeah.
They were up like 80% overnight because you could view the options move on the VIX, right? That was
Yeah,
like 80% on a monthly contract. Like,
we were
as
killing
crazy
it.
we were, but the thing is, bro, that contract should have been up like 200%
That's what I'm
realistically.
saying. I feel like it put me on tilt, if I'm being honest, on
Yeah.
Friday because going to bed, I'm like, I'm gonna be up massive in the morning. And then when I wasn't, I had to adjust mentally and it just frustrated me all day. But yeah, I agree. We should have been up way, and that's what I'm saying. Like it's a weird VIX reaction to something that historically should have been a huge reaction, I think.
Yeah, absolutely. I mean, it was so funny, man. Like, I had a feeling in my head. I just always have a feeling where, anything that happens overnight, I can't trust it until the market opens because
Yeah,
everything can change. And
so true.
I was so unhappy at the fact that I was right because I don't like being right because my thoughts are always like, plan for a worst case scenario. So I'm like, I get all these messages like 80%, Kevin. Oh my God, we're gonna be so up. I'm like, okay, all
Just
right.
hold on. Yeah, I know.
Yeah.
I've definitely had to adjust my reactions to futures moves at 7 8 p.m. because it's so true. Like I've seen you and I both have seen it happen so many times where you can be up big and it just completely reverses at like 3 in the morning for some random reason, right? Like so you can't really trust the overnight moves too much sometimes.
Yeah, and the funny thing was, what was it? The contracts were at 80% max profit, I think, before market open. At
Yeah,
market open, bro, they were at freaking 30%. I
I
remember it
know.
kept
I was
on.
so bad.
Uh, I filled right after market open. I saw where the bid and ask was. I filled because you could see it before market open, so it was very easy to fill.
Yeah,
But I trimmed out, and I'm just like, I closed out
those
on my.
things. Go ahead. Go ahead.
So I have my desktop. So the way the active trader work, it doesn't show the percentage profit. It just shows the active P&L in dollar amount. So I don't know how much percentage. So I have my tablet next to me that shows my Thinkorswim app, and I'm like closing and opening. I'm just looking at it. I'm like, there's no way. That's just 30%,
I
bro.
know.
That's crazy.
And I actually looked. I think it was on like Webull. You can see the price, the bid ask charted out for each option,
Yeah.
and it was showing a spike overnight to like 395. I was like, oh my gosh, like that should have been
Oh my
that should
God.
have been it on Friday morning. But such is the market, right? Yeah, no, it's definitely an interesting development with Israel and Iran, and we'll obviously have to see how that plays out. I'm not an oil trader, but man, I wish I was right now,
Oh yeah.
because that's definitely getting impacted there. But it just seems like an odd reaction, and it seems like the market is very, very resilient right now, which is just astounding to me, considering the fact that we're still in an environment where there's a lot of unknowns with tariffs, and we don't have to open up that can of worms if you don't want to. But just the fact that that 90-day pause is coming due right in
Correct. Yeah.
July, and we don't have a resolution yet. And practically speaking, I don't think you can get a resolution for everybody in the world. So there's going to be letters sent out. And so there's just a lot of ambiguity there, a lot of, stuff up in the air. And so even in light of all that, we're still, getting close to 6,100 on SPX, unless I didn't even look, maybe we eclipsed it, but we're getting close to new all-time highs. And so it's insane. It's insane to me. But the market can stay irrational longer than you can remain solvent.
Oh
The
yeah.
old adage.
Oh, dude, you have no idea. And that's the thing. Like, we're in such a weird spot because all these, the previous very strong bull markets was not in the. They just weren't historically in a situation like we are right now.
Yeah.
You know, for example, tariffs in previous markets, they used to have a very negative impact that would lead
Sure.
to bear markets that would not last an extra amount, but it would be a normal bear market. This was not a normal bear market. Very few instances where we have it like this. And then on top of that, foreign, you know, bro, we could go whatever extent you want. I'm fine. I just don't know what extent you want to go to. But just like to the,
Yeah, yeah. I'm good for, we can do another like 20,
yeah,
30 minutes if that works for you.
yeah, for sure, dude.
All right.
It's just like, yeah, it's crazy because this So I always think like this. I have very weird analogies, so don't mind me. But I think of it like building a house, right? The market's like building a house. You build it all up. You know, when you first build it up, just like when a new bull market starts, everything is strong, everything is solid, right? Time goes by. You know, let's say you have, for some reason, a fat kid in your house, right? And if that fat kid goes upstairs and keeps on taking a bath and he keeps on jumping up and down on the floor, you know, the first few years, first 20 years, that's fine. You know, that floor will last. As time goes on, you know, the foundations that was there initially for that new house being built is not going to be as strong. As that's the same thing we could relate to this bull market, right? You know, when the rally first started, it was very strong, right? You could see the volume was there. You could see that the strength, no matter how bearish the news or whatever, the passion mango fruit opened up his mouth and talked about tariffs. People didn't care anymore. Market just went up, right? But then to
Right.
what extent will that stop, right? When will the floor just buckle itself over and then the fat baby will fall? And then in this case, that'll be this market, right? When will this market be, you know, dropping or will it just keep going up? So yeah.
Yeah, it's so strange to me. I felt very I don't know. So I've been trading. I don't think I mentioned this, but I've been trading for about 5 years, right? So
Yeah.
a little less than half the time you have. But I was around, of course, for 2022, Russia invading Ukraine, right? That was my first experience, taste of a bull bear market, I mean, if you will.
Hmm.
And so when this started with the tariffs, I was like, oh, I've seen this before. I know what I need to be looking at. And then, yeah, just we had that massive historical Green Day on SPY when, President Trump announced the pause. And really, since then, it's just been this resiliency that continues, right? All you got to do is zoom out as you're doing and see, it's been going up. So it definitely seems like a regime shift. Technically speaking, we are out of bear market territory, but I'm still I'm still a bit iffy on it.
Yeah, you know, I feel you, bro. I mean, you can, I feel you, and I don't think, I feel the same sentiment as you, but I don't think I'm going to be taking short positions as much. You know what I
Yeah,
mean?
no,
Yeah.
same here.
I
Yeah,
think, for example, since, you have viewers on iTunes or who can't see what I'm seeing right now, if you go to SPX and you go on a line chart, which just makes it, very simple to look at. If you see, like, yeah, we still have not created a higher high on the daily or the weekly on SPX. So, like, everyone's valid for thinking that. So, if you get above and you create a higher high, okay, all right, there's a little bit more relief on maybe we're going to continue upwards. But then, you know, you also have the issue where we could potentially double top. And the thing that's concerning is usually whenever you're getting to an area like this, you would want higher volume. We're not getting higher volume. That's the thing that's concerning. Always sets me back. I mean, I'm still gonna try to look for the bull setups, but dude, I mean, if the volume does not increase from here, if we bounce somehow, and we go back up to above 6,150, we need to definitely like increase in volume, or we're probably gonna reject.
yeah. You know
Yeah.
what's doing well right now though?
What's up?
Your buddy JP. For those who haven't heard it, I interviewed JP, another seasoned trader, a couple months back. Kratos.
Oh my God. Yeah. Yep.
That thing is still going strong. Holy cow.
Yeah, bro. You could actually see it hit my. I use Fib extensions. Fib extensions is a great asset. If you do not use it right now, I think you should definitely.
Yeah, I've
Uh,
been exploring it more. I hadn't used it to be honest until a couple months ago. I'm still getting familiar with it, but it seems like an excellent tool.
Absolutely, yeah. You could use intraday trading or swing day trading. But one of the greatest ways you can use this for long-term investing. This thing has been following Fib extensions pretty perfectly, and you could see that we reached the first target I really had here on the second target, I would say, which is 41.65. We're kind of hesitating there, but my goodness, I mean, of course, with this conflict right now, I mean, Kratos and any other,
News
military site.
catalyst.
Yeah, exactly. So
Yeah.
if this keeps continuing, you're probably going to see it reach up to 52. And worst case scenario, I mean, worst case in terms of for the world, you're probably going to see it go up to 70 or even 88, which, if people are holding this, of course, props to you, but
Yeah.
I don't want it reaching up here and anytime soon because
No.
that means
No.
we're screwed. Yeah.
You don't have to pull it up, but do you know off the top of your head like how the IV has kind of been impacted based off some of these recent bullish moves in Kratos? Is it like getting inflated? Are they still reasonably priced based off the IV percentile? Do you know any of where it's at right now?
That's a really good question. I could actually search it up really quickly.
Okay.
But when it comes to, for example, you said you haven't really traded oil stocks that much, right?
Right.
Yeah, so obviously you've heard of crude oil futures,
Sure.
CL. Future options, there's actually options for futures. And when it came to this whole event with Iran, obviously oil is going to be impacted, right? So oil companies across the board increased in IV, whether it's the futures on CL, or simply down to XOM, they all increase in IV. And usually you only see IV increase on beat downs. But when you have such sharp moves to the upside, you're always typically going to see IV increases on these companies. So let me see Kratos. So for example, I go according to the IV percentile and the IV rank. So for example, the IV rank for Kratos right now is just 35, which is not extravagant amount, but something like such as crude oil futures and USO. USO is the ETF you could trade options on. The IV rank is all the way up at 68, which is very high, right? That's like close to 100. So the closer you are to 100, the higher the IV is. So for example, IV on USO is 68. XOM I think was pretty high as well. No, IV on XOM is pretty low at 27%. So what we're kind of seeing here, and this is actually something I discovered with you right now, the stocks are actually on a single basis are not increasing in IV,
Right.
but the ETFs are. So Kratos by itself is actually not in a high IV environment compared to its usual IV.
That's interesting.
Yeah.
And it seems one thing I have noticed as I pay more attention to implied volatility, IV percentile, they obviously get inflated when they tank.
Mm-hmm.
Typically have more volatility, stair step up, elevator down, right? But when you get bull runs up, I feel like I've noticed that the IV percentile doesn't change a whole lot there, right?
Correct.
You don't see implied volatility get inflated, for example, on a bull run up. So I've always thought that's kind of interesting, But yet, I mean, you still benefit from calls if it's going up, of course. But
Yeah, absolutely. That's what makes actually a bear market a little bit dangerous, right? Because as we stated, the drop downs. Why are drop downs so volatile? Very simple. If you don't know the concept of IV, and not talking to you, I'm talking to your viewers. Think of IV as just a measured move, right? Obviously, whenever there's drops and panic sells, you literally have to focus on the word panic sells, right? The sells are very sharp, as you could see when the whole tariff thing came out. So that's why IV increases, because your move that you can get on the intraday or even on an overnight basis is very large. But when you get rallies, typically, the first bounce, of course, IV is pretty high because it's pretty a strong bounce. But after that, you could even look back at SPY. I mean, it's a very slow climb up. So that's why when you get even on the intraday movement, if, for example, let's say SPX is having a bearish day, the IV will be very high. But then let's say 2 hours before close, IV will be very high, but then the second, the market bounces and it starts climbing up, you'll see IV decrease so much. And if you have Thinkorswim, if you're looking at a chart, you could actually add an indicator or a study called implied volatility, and it'll actually show you intraday. So the difference is, IV does typically 90% of the time decreases on rallies. But when you get, for example, CL, which I pulled up on my chart here, which tracks crude oil, these things usually consolidate a lot. You do have drops, and of course the IV increases on these drops, but since it's such a catalyst thing, news driven, the spikes are going to be so huge that the IV increases as well. And if you don't trade futures, you could just look at USO, and it's the same thing there, right? It ranges, and then when news come out, I mean, you could pull up the USO daily chart. I mean, look at that move. That is just huge, and that gap up is huge from Thursday to Friday. So yeah,
awesome.
is massive on it. Yep.
Well, that's great, Kevin. Thanks so much for kind of breaking some of this down here. I think we'll start to wind this down here. I definitely appreciate you taking the time to come on, and would love to have you on again later on in the future. This has been excellent. I think we got a lot of good content here for everybody. Where can listeners go to, learn more about you, see some of the trades you're taking, or I know you put out a lot of free education as well for the trading community. So where can people go?
Yeah, so I'm all about free education. That's one thing I highly advocate for, and props to you for also following along that line with your YouTube channel. You could search up our YouTube. It's called Taylor Trades LLC, and then what that YouTube consists of is all the live recordings from our free educational server called Live Sessions. You can also join that server through the links on that YouTube. Um, but if you also have Twitter, you can follow me on at the Market Bishop. It's spelled exactly as that. And I mean, yeah, that's pretty much it. I mean, YouTube and Twitter, I guess.
Okay, awesome, awesome. Kevin, thanks so much for taking the time to come on. This has been great. I've been looking forward to this for a while. I know we've been going back and forth, and I'm glad we were finally able to get it lined up. And for anyone listening, thanks as always for showing support. Make sure to share this with a buddy. You got somebody who's interested in trading. This is excellent material here from a seasoned trader. Don't forget to subscribe, and drop a comment. If you got a question, feel free to drop it in. I can pass along to Kevin. Maybe we can get some of those answered. But thanks as always, folks. And remember, plan the trade and trade the plan. Have a good one.